You see a headline, a company like Apple announces billions of dollars in sales. Seems pretty simple, right? They sell an iPhone, they get the money. But what if I told you the number they report isn't really about the cash they collected? The real story is, well, it's a lot more interesting than that. Today, we're going to pull back the curtain and look at the rules that decide when a sale is actually a sale. Let's dive in.
So just take a look at this number. In 1 year, Apple reported over $294 billion in product sales. It's a huge, staggering figure. It's the kind of number that just makes you stop and stare.
But here's the real question, the $294 billion question. Is that number what you think it is? Did all that cash actually land in their bank account that year? Well, the answer is it's complicated. And understanding that complication is the secret to figuring out the true financial health of pretty much any company out there. To get to the bottom of this, we have to look at the official rule book that all accountants have to follow. It's a big concept called revenue recognition. And the key thing to remember is this. It's not about when you get the cash. It's all about when you've earned it. And there's a very strict 5-step process for that. So here it is, the 5-step checklist. It all starts with a contract, the agreement. Then you have to figure out your specific obligations. What exactly did you promise to deliver? After that, you've got the price. But here's the really clever part. You have to take that price and split it up, allocating it to each separate promise you made. And only then, once you've actually delivered on one of those promises, can you finally, officially count that slice of the revenue. It's basically a system to stop companies from counting their chickens before they hatch. Let's make this super simple. Imagine a gym sells you a 1-year membership for $1,000, and you pay it all on day 1. Does the gym get to book all $1,000 as revenue right away? Nope, no way. They've got your cash, sure, but they haven't earned it yet. Their job, their performance obligation, is to provide you with a gym for a whole year. So they can only count or recognize about $83 each month for all 12 months. Okay, so let's apply that same logic to a tech product. Say you buy a new Mac for $2,000, and maybe that price also includes a 3-year warranty worth $500. Apple can count the revenue for the computer itself right away because you have it. But that part of the price that's tied to the warranty, they have to recognize that bit by bit over the full 3 years. Why? Because that's how long their promise lasts. So that 5-step process works great when the cash is paid up front. But what happens when it isn't? In the world of big business, most sales are actually made on credit. This throws a huge wrench in the works. You've technically earned the revenue, but you don't have the money yet. This is where we enter the world of corporate IOUs. And that brings us to a super important term, accounts receivable. Honestly, you can just think of it as a company's giant folder of official IOUs. It's the total amount of money that all of its customers have promised to pay for things they've already received. It's revenue they've earned, but it's cash they're still waiting on. And this, of course, leads us to the most obvious and kind of dangerous question. What happens when people don't pay their IOUs? I mean, every company that sells on credit knows that, statistically speaking, some of their customers are just going to flake. So how on earth do they account for money they've technically earned but will probably never, ever see? Well, companies have to be realistic, They know for a fact some of those IOUs will go bad. They can't just cross their fingers and pretend all that promised money is a sure thing. So they need a system to account for that risk. The solution is to track 2 numbers. First, you have gross receivables. That's the grand total of every single IOU, the whole shebang. But then they subtract an estimate for what they think they'll never collect. And what's left is net receivables, the amount the company actually expects to see hit the bank. It's the realistic number. So how do they make that estimate? They don't just pull a number out of thin air. They use a tool called an aging analysis. It's just a systematic way of looking at all their IOUs and sorting them by how old they are. The logic here is pretty simple. The longer a bill is overdue, the less likely it is you'll ever get paid. And here's what that looks like in practice. For the really new debts, say 0 to 30 days old, they might only expect 1% to go bad. But for debts that are over 60 days old, whoa, that risk might jump up to 15%, maybe even higher. They add all these different buckets up to get their total expected loss. Now, this estimated loss isn't just a little note in a file somewhere. It becomes a real expense on their income statement, and it has the perfect name, bad debt expense. So here's the crucial takeaway. Making a sale to a customer who never pays
doesn't just mean you don't get the cash, it actively costs you money in the form of an expense. Okay, get ready for a little twist. Could a company's bad debt expense ever be negative? I know it sounds crazy, but the answer is yes. How is that even possible? Well, it happens if a company was a little too pessimistic last year and overestimated its bad debts. If customers end up paying more than they expected, the company gets to reverse some of that old expense, which shows up as a negative expense, which is kind of like a small gain.
So, we've seen how revenue is counted, and we've seen how companies deal with the risk that they won't get paid. That brings us to our final section, putting it all together. How can we use this knowledge to check the financial pulse of a company? There's this really powerful little formula for this. It's called the average collection period. All you do is take the company's accounts receivable, their total IOUs, you divide it by their total sales for the year, and then multiply by 365. The number you get tells you something really fundamental about the business. So let's apply this to our case study. When you run the numbers for Apple, you get an average collection period of about 41 days. What this means is that, on average, it takes Apple 41 days to collect the cash after making a sale on credit. But what does that number actually tell us? I mean, is 41 days good? Is it bad? Is it a sign of a healthy, efficient company? Or is it maybe a red flag? By itself, the number doesn't really mean much. Its real power comes from context. A lower number generally means the company is really good, really efficient at collecting its cash. A higher number means more of its capital is just sitting there, tied up in IOUs, waiting to be collected. And that can be risky. But the real insight, the real magic, comes from comparison. Is 41 days better or worse than Apple did last year? And how does it stack up against their main competitors like Samsung? That's when this simple number becomes a really powerful tool for analysis.
So a sale is never just a sale. It's the start of a whole story about contracts and promises, risk and cash. And by looking past that big headline number, you could start to see the true rhythm of a business. So now that you know how to read this financial vital sign, what company's pulse are you going to check first?